I don't actually care about temporary changes in the stock market. Market volatility is a normal thing, and we also see market recovery. The scary part about recession is the uncertainty and the way that economic downturn affects all of these other aspects of our lives. And that's what we have to pay attention to.
Hi, this is Monica Packer, and you're listening to About Progress, where we are about progress made practical. Brad and I got married in the month of December in the year 2007, otherwise known as the first month of the Great Recession. While we didn't yet have kids or a mortgage, this was still a scary, insecure time for us. Brad was a peon at his job, and I was back at school training to become a teacher, which entailed us taking on some debt. I'll never forget one afternoon returning to our apartment after class, screaming when I saw a pair of legs hanging off the end of our bed that were clearly a man's. Brad called out to me from our bedroom, letting me know that he was home and early because he had just been laid off. In a span of, half a second, all these thoughts swirled over me. How were we going to make it? Would we be able to pay rent? Would I need to quit my program? Are we going to have to move? Those thoughts were Brad's too, hence him laying on the bed trying to think it all through. We did make it through that time, and we're luckier than most. Brad was able to find another job, so all the other question marks were taken care of. But now it's almost 18 years later, and I can honestly tell you that the feelings of insecurity never really went away. And now they are exacerbated by the facts that we do have a mortgage and 5 kids, and all that comes with feeding them, clothing them, and enriching them. Oh, and the fact that experts are saying another recession is coming around the corner, even as we are in the middle of experiencing inflation. Between rising prices, talk of recession, and the daily juggle of family finances, it's no wonder so many of us feel uneasy about money right now. Today, certified financial planner Elizabeth Pennington of Fearless Finance joins me to help answer one of the most common and emotional questions women ask. Am I okay financially? In her response, Elizabeth breaks down the 5 steps to feeling financially secure even in uncertain times. You'll learn how to simplify your budget, prepare, not panic, for a potential recession, and build confidence in how you manage your money, no matter what's happening in the headlines. Elizabeth Pennington is a certified financial planner with Fearless Finance, which offers fee-only hourly financial advice virtually to clients around the U.S. After starting a policy career in Washington, D.C., Elizabeth initially struggled with her own finances and had to learn how to manage her money. As she started her financial journey, she realized that she wanted to work to make financial advice accessible to everyone, not just people who were already wealthy. She switched careers and joined Fearless Finance in 2019. She became a minority equity owner of the firm in 2022. Elizabeth especially enjoys working with underserved communities to help them start financially strong and meet their goals. It's worth saying that this episode is not sponsored in any way. Fearless Finance has been a podcast sponsor in the past, but this episode was only because I loved learning from Elizabeth so much and invited her to be on. I can guarantee that this is an interview you will want to listen to a few times and share with your loved ones too, so everyone can learn how to save, spend, and stay sane in a shaky economy. That interview is coming up after a quick break for our sponsors. Just because your neck and arms might be more covered this fall doesn't mean you should pretend they don't exist. Your skin still needs love, especially your neck, and why not your arms? That's exactly why Go Pure created the Neck and Arm Cream Bundle, a powerhouse duo designed to visibly firm, smooth, and restore the look of sagging, crepey skin where it matters most. I think a lot of us have some kind of drawer full of barely used products. These creams will not be one of them. I can speak from personal experience because my first jar of the Tighten and Lift Neck Cream is one of my few empties, meaning a jar that's totally empty. I recently went on to gopure.com to replace it using my own code, and instead of just getting that jar, I went and got the Neck Cream and Arm Cream Duo, because for a limited time, it's 57% off that bundle. GoPure isn't just about transforming the skin on these areas. They have a full line of science-backed skin and body care to tighten, lift, and smooth skin from head to toe without the harsh chemicals or hefty price. Go Pure over-delivers on value with over 100,000 real women with real results. Right now, Go Pure has a crazy deal. For a limited time, you can get 57% off the Tighten and Lift Neck Cream and Sculpt and Tone Arm Cream Bundle. You can also get 25% off all other products by using code PROGRESS at gopure.com. So head to gopure.com and use code PROGRESS for a huge discount. And after you buy, do us a favor. When they ask where you heard about Go Pure, tell them it was from our show. I have really exciting news on the book front. A quick catch up if you haven't heard, I have been writing a book on gentle, flexible habit formation for women this year. And I am so lucky to have gotten a literary agent and now a book deal, which means I can officially tell you the book is called Happy Habits and it will be released hopefully in the fall of 2026. And this is where I need you. Leading up to the launch of this book, I need a committee of gal pals just like you to be my early test readers, to pre-order the book, and to act as grassroots publicists the moment each of these steps are made ready, and to potentially act as an advanced reader. Would you like to be on that book launch committee and get the latest updates, behind the scenes, and first dibs on all book news while you're at it? Go to aboutprogress.com/book committee. And when you sign up, you'll get a newsletter automatically with all the past updates I've given, including behind the scenes and sneak peeks. The link is in the show notes for you. Again, it's aboutprogress.com/book committee. I can't wait to share as much as I can with you along the way, and I am so eager for you to get your hands on this book. Elizabeth Pennington from Fearless Finance, welcome to About Progress.
Thank you so much for having me, Monica. I'm excited to be here.
We're going to start with a couple disclaimers. Mine first is this episode itself is not sponsored, but you have been a sponsor of the show in the past, so we will have an affiliate code for them at the end that lets them know they found you from me. And you have your own disclaimer as well. Do you mind sharing that with us right out the gate?
Okay, yes. I am a financial planner. I am not the listener's financial planner.
Yeah.
So while we're talking about these topics from an educational and entertainment standpoint, none of this should be taken as personal investment advice.
Okay, really important. And with that being said, there's going to be so much here that people are going to be able to use to change the way that they are navigating these uncertain times when it comes to the economy and their own finances and what's coming up. And that's why we're here today, because times do feel uncertain, and they feel that way in terms of our finances too. And finances are already tricky. They're already very layered too. It's not just the how-to, it's the relationships that are involved. It's the old patterns and the ways that we were raised, the ways that we view money. And also there's just so much to do money-wise. There's so much to save for. There's so many moving parts. And now that we're all fully overwhelmed, let's start with what you think we need to prioritize the most in terms of right now, where we're at and the climate we're in, also connected to what we need to be aware of financially.
All of the time, I get clients who come in and say, I just want to know I'm okay. Tell me I'm okay, whatever that means. And I think that's a relevant question in normal times and uncertain times. And so I want to talk through kind of the 5 steps that I look for with clients when answering that question of, are you okay or not?
Okay.
The first is that you have to have a stable cash flow. You have to spend less than you earn. Because if that's not happening, you can't save for goals, you can't make progress, like nothing else is going to move forward. The second is that you have a rainy day fund for the next time you have to go to the ER, or you need new brakes for the car, or the water heater gives out, right? I'm usually looking for around $3,000 here. The third is that you have a full emergency fund, which is different. This is for you lose your job, you get divorced, you're disabled. You need at least 3 to 6 months of your expenses in that emergency fund. Number 4 is that you have no consumer debt. I'm talking about high interest debt like credit cards or some predatory personal loans. Those are just eroding your cash flow overall, so we need those fully paid off every single month so that you're not accruing interest. The 5th point is that you need to be saving enough for retirement.
Okay.
Retirement is a hard one for people because it feels like there's so much going on in your normal life that like that'll happen in the future. But let me tell you, the hardest planning I do with clients is when they come to me at 55 or 60 and they're behind and they do not have enough time to catch up. But then we have to have hard conversations about your retirement's not going to look the way you thought it was,
Got it.
or you're going to have to work longer. And I don't want to have that conversation with my clients. I do. And also, the more we can do to avoid that conversation, the better. So, what does it mean to save enough for retirement? That means that as long as you are starting in your 30s with retirement savings, you're saving at least 15% of your income annually, net
Okay.
income. This includes your employer match. If you're starting in your 40s or later, you're going to have to save more, and we probably need to do more detailed planning to figure out how much more.
Okay.
Note that if you have a pension or anything kind of else happening there in terms of income and retirement, that 15% target may not be as relevant. But even for my clients with pensions, I'm looking for 10 to 15% most of the time. Those are the 5 steps. The other thing I would kind of flag, given some of the uncertainty that we're all feeling, is just focus on what you can control. Like, I know
Okay.
there's a lot of noise and a lot of stress out there. Things have been a little rocky in the economy this year, but there's no point in borrowing trouble. Focus on what you can control. Try to ignore the rest of it. And those 5 steps are a really good place to start. Once you've hit the 5 steps, then we can talk about like extra credit goals. We can talk about saving for college or buying a house or renovating. But all of those things take second chair to the 5 steps.
Okay. I love those 5 steps, and those for those listening, we will make sure we include that in the graphic for this week so they can refer back to it easily. But I love how going through those 5 steps is going to help you answer the common overarching question, am I okay? Because I remember on our first meeting with you, that was my main question. Are we okay? And being able to answer those questions helps me know that and to what degree we're doing okay, because we all have some improvement, I'm sure. You brought up the need for retirement and even college or renovation. I know that we're going to focus on what we can control, but there are some uncontrollable things or maybe potentially uncontrollable things happening, like a potential recession. Some people are saying we're already in one and they just don't quite know it yet. Can you tell us what are some things that they should be maybe aware of potentially happening in the near future in terms of those bigger life things that they need to be aware of?
Yeah. So recessions specifically, look, I hope that this next statement ages poorly and I'm wrong, but it does feel like a recession is coming. I'm seeing a decent number of my clients losing their jobs or feeling uncertainty with their employment, more than I would normally expect. So, also, it's hard to know. I've been doing this for about 6 years now. And if I went back, I could probably find half a dozen articles every single year that said recession's coming. Like,
Mm-hmm.
this is it.
Mm-hmm.
A broken clock is right twice a day. And some of the recent kind of tariff stuff is going to make a recession more likely. So it does feel like it's coming, and I think it's a good idea to be braced for that. And if I'm wrong, then you just saved extra money, and that's never a bad thing. What I would do if we're worried about recession is you might want a larger than normal emergency fund. I
Okay.
said 3 to 6 months of expenses as a minimum. Maybe you want more than that, especially if you're worried about your job in particular, if you think layoffs are likely or you're in an industry that's going to be particularly affected. The other thing is I would consider deferring optional purchases.
Okay.
If you think that you're going to lose your job, this is not the time to buy a new house or do a major renovation or commit to an all-out expenses like Disney cruise situation.
Sure.
Maybe don't stretch yourself financially. Pull back, wait and see, then we can make some of those larger decisions if all of this blows over.
Okay, those are great ways they can take action on that. Can we go back to the word recession? Because there are people like me that were English majors and teachers, and they did an econ class in college one day, but even though I've lived through a recession technically, and I knew the ramifications that we faced as a family during that time, I'm not entirely sure what it means.
Yeah, so the the economic definition is that we have to see kind of a fall in GDP for 2 quarters. There's different definitions we could use, different kind of measures we use to tell if we're in a recession. I also think that the official definition of a recession is not that helpful
Yeah.
because what we actually care about is the feeling, is the
Mm,
impact on our lives.
okay.
So, in terms of like everyday finances, what matters about that recession is not that the GDP is down or the stock market is down. It's that the stock market is down at a time where we might need the money,
Mm.
or the stock market or GDP being down means that we lose our jobs, or that it's harder to sell our house when we're moving. Like, I don't actually care about temporary changes in the stock market. Market volatility is a normal thing, and we also see market recovery.
Mm.
The scary part about recession is the uncertainty
Okay.
and the way that economic downturn affects all of these other aspects of our lives. And that's what we have to pay attention to.
And so the market responds to that uncertainty in a couple ways that may also affect our finances, like a potential job loss or a change to the job market in general. But are there other kind of things that may impact their wallet if a recession does hit, even if they don't lose their jobs?
Well, so in terms of kind of the feeling of uncertainty right now, our firm is founded and based in the Washington, D.C. area. And I can tell you that my clients in D.C., houses are staying on the market longer and are selling for less. And so while that may be a DC specific thing, we don't know if that's going to ripple out other places. But I'd argue we're seeing that where I live in Des Moines, Iowa right now. So whether or not your job is okay, it could also have an impact on real estate.
Okay.
It could have an impact on how much you're making in your job. If you're
Mm.
in an industry where bonuses are really common, it might mean that you don't see a bonus this year, and that might affect your planning if that was money you were counting on. So we have all of these other pieces that are also affected.
And we talk a lot about grocery prices in our just like day to day lives. I feel like I'm talking about it with even the cashiers I'm checking out or a neighbor in terms of like how much food is costing. Is that related to a recession too, or even other things like gifts that we're getting or school supplies at the store, clothes?
Yes and no. So inflation is different from recession.
Hmm.
You can have inflation without a market downturn, and you can have a market downturn without inflation. I think right now is particularly scary because we have to be braced for both.
Got
We
it.
had just recovered from some of the really high levels of inflation during COVID.
Hmm.
And we all remember what that felt like, right? I think we're all still kind of having a little bit of whiplash from that. And now, if we have tariffs against major trading partners, it's going to get worse again. And so, when you have higher prices paired with a recession, with job loss or uncertainty, keeping kind of the baseline minimum that you need is harder because everything's more expensive.
Hmm. Hmm.
And so I want to acknowledge that. Like, this
Mm.
is particularly scary because of those two factors being combined.
Okay.
And again, there's only so much we can do about it. I always think it's a good idea if you are directly feeling impacts of things like this. I think it's a good idea to make that known to your representatives on both sides of the aisle. They want to hear when their constituents are hurting. So, like, not to put in like a political like activism plug, but you have constituent services offices. Like, it's a good idea to reach out and make yourself heard when
Mm.
you directly are affected by these policies. Because even though there are times where some of these policies could have good impacts, they could have a good purpose and a good reason for being. If it's hurting you, that's cold comfort. So, other than that, though, there's only so much we can control. And if things are more expensive, it might mean that you're doing without on things that are more optional so that you can save up more. As hard as that is.
So the tighten the belt feeling that we're getting is actually wise to lean into right
And
now.
I want to say though that I'm not saying don't spend any money in your lives because it's also not healthy to be like, we can never eat out again. A
Uh-huh.
recession is coming.
Yeah.
Uh, don't do that to yourselves. Like if you have already lost your job, you're going to want to scale way back. But if you're just trying to save up more and you have kind of a relatively normal cash flow situation overall, what I would recommend is look at your overall spending, where your money is going month to month, and in a couple places, just pull back slightly.
Okay.
So one example is that when I'm talking about spending with clients, because often I go through cash flow with my clients in most cases, and one thing I like to do is for all of the discretionary expenses that you have monthly, the eating out and buying stuff for the kids and household purchases, clothes, entertainment, etc. I don't like to track those as individual line items. I like to track them as one bucket, and we call that bucket your flex dollars.
Okay.
And so I'm not saying, even when I have clients who come in and they've lost their job, I
Mm-hmm.
don't put their flex dollars at zero. They're still going to need to buy shampoo,
Yeah.
but their flex dollars cut back significantly. So
Okay.
if for a family of four, it's normally at 2,000 when things feel comfortable and secure and normal, I would say 2 to 3,000 is pretty typical. If you've lost your job, we're going all the way back to $1,000 a month. And that'll get you the things that matter the most to you, but it's basically cutting out everything that's extraneous. So if you're worried about job loss that it hasn't happened yet, and you are normally spending $2,500 a month on those flex dollar expenses, maybe you track for a few months and try to get to 2,000 a month. Because that's $500 a month that can go towards extra savings, and that's a big
Sure.
deal.
Okay. I love the not all or nothing approach, but still making traction towards being prepared for something that could happen. And like you said, at the end of the day, you're okay. At least you have more money at the end of the day, which is great to count on. You're bringing up something that was originally why I wanted you on the show because I came to you, like my husband and I paid for sessions too because we just loved working with you so much. But one of the biggest takeaways I got personally was how you look at budgeting and you brought up the flex dollars as a whole bucket. What would be the other bucket? Like, what do you call that?
Yeah, so I separate expenses into a few different categories. There's the ones that I want you to track, which are flex dollars,
Okay.
groceries, because we all overspend on groceries if we're not watching it, and annual expenses, the things that come up less frequently. The travel, the Christmas presents, the insurance that comes twice a year, vet bills,
Mhm.
things like that. I want you saving on a monthly basis for annual expenses and tracking overall spending in that category.
Okay.
Everything else in your cash flow doesn't involve active decision making. It's your mortgage or your rent. It's buying gas for the car and paying your utilities. And yes, you might see some fluctuation in those numbers, but it's not because you went and like splurged on electricity that month.
Sure.
Like you
Yeah.
didn't spontaneously buy extra gas for the car for fun.
Yeah.
So I don't care about tracking those things because there's not a whole lot you can do when your car is out of gas, you buy gas. So I would see kind of that broken down then into four main buckets. The three different things that you do track and the one big bucket that you don't have to track, as long as your cash flow is stable. Very rarely, I do have clients who come in and enough of their money is going to fixed or stable expenses. The mortgage, daycare is a huge one.
Mm.
Tuition can be big, insurance, debt payments, things like that. Enough of their money is going there that no matter what we cut, they are never going to get to a stable place. And then we have to think about bigger shifts to the stable expenses. But barring that, for most people, those are expenses that we can safely put on autopilot and not worry about.
The biggest driving force to my work with About Progress has long been my passion for helping moms thrive. The reason for this is because what we need now more than ever are capable women, mothers especially, who have more fulfillment, joy, and progress in their lives. I've seen with my work that women often desire more in 5 pillars: happiness, habits, health, home, and hobbies. That's why I created the More for Moms conference, where 25 high caliber speakers speak under each of these pillars in very unique, compassionate, but also motivating ways. Women who attended the conference have so much good to say about it. It was just the boost they needed. It helped them feel more seen. It gave them the information they needed to do things differently. The live version of this conference is officially past, but it is still available for you as a standalone self-paced course. Signing up for More for Moms will give you access to those 25 speakers in 3 different formats, so you can watch, read, or listen to each session. Just imagine a year's worth of About Progress being put into a single course. That's what this is like. Listeners of my podcast get $20 off by using the code LISTENER at checkout. You can do so at aboutprogress.com/moreformoms. Again, that's aboutprogress.com/moreformoms. So that's nice to have those buckets. I'm just going to review them for people. We've got what would you call the bucket where you don't have active decision making, like the cash flow that
I
is
call
there a
it
name
kind
for
of,
it?
I don't think of it as a bucket so much as what's left over, but I'd call it fixed and stable expenses.
Okay. So you've
Fixed
got
and stable monthly expenses.
Okay, so fixed and stable monthly expenses, the kind that you don't have to actively make decisions on each time you pay the bill or it gets paid for you. And then you've got flex dollars and groceries and annual expenses that come up. Is that right?
Yep.
Okay, and you want us to track the last 3. What do you mean by tracking? I know I'm doing like basics 101, but it's just so nice to pick your brain.
Yeah. So I want you tracking the last 3 buckets proactively. That doesn't mean that you check your credit card statement to see the damage at the end of the month. It's too late to do anything about it at that point. So I want you tracking proactively so that the next time you're thinking about spending money, you go and check your flex dollars. I just did this. There was a sale and I wanted to buy a new dress. And I said, okay, I am halfway through the month. I've frankly used about half of my flex dollars. If I buy this, which is an unexpected expense, I'm going to have to skip eating out next Friday. I'm going to have to choose to give up something else. If I had checked my flex dollars and I had been 2/3 of the way through them, halfway through the month, I would have skipped that sale. So you have to track proactively and use it to influence your spending. Because if you're watching it and you see yourself go over and you don't change anything, then that tracking isn't accomplishing anything. Same with groceries. If I'm at the end of the month, I got like a week left and my grocery budget is gone, I am eating the random stuff I have in my freezer and my pantry because I know that we all have it, right? The things that I've been avoiding because they just didn't sound that great. That's my cue. I'm eating those that week.
Yeah.
In terms of how you track,
Yes.
there's a few different options for this. We have our own app as a firm that is free for anyone to use if they link 3 accounts or less to the platform. And it pulls in your transactions and tries to automatically categorize them. And sometimes it's wrong and you just correct it. So that is an option. It works really well for some people. It doesn't work well for other people, and that's fine too. If you're already using a more traditional budgeting app, YNAB or Monarch or Rocket Money, all of those can, and I would say should, be customized to match this flex dollar concept. Because the biggest mistake I see with clients who come in and they're already tracking their spending in one of these apps is that they have like 30 different categories.
Yes.
And it's exhausting. And it's like, well, I went to the bar and is that entertainment because I was with friends, or is it eating out? And is it
Yeah.
eating out alcohol, or is it eating out takeout? And like, don't do that to yourself, please. Like you have one wild and precious life. Don't spend it with 30 different budget categories. So if you want to use one of those options, streamline it.
Okay.
Lump all your flex dollars together, lump all your fixed stable expenses together. Your mortgage and your student loan payment and your internet bill can all be in one line on that budget.
Got it.
Finally, sometimes clients are just not going to use a budgeting app. It doesn't work for them. It doesn't work for their brain or their life. The bare minimum you have to do is tracking the flex dollars. And you could do that by putting all of your flex dollars on one credit card and watching that credit card total. You have to be pretty rigid about making sure your expenses are on the right account, and that's hard. But if you're able to save kind of the predicted amount that we think you should be able to save every month, because that money moves out automatically and the rest of the math works, that might be okay. But I would say that very few of my clients fall into that bucket because I see more overspenders than I do oversavers. And I think as a society, we tend to be overspenders more than oversavers.
So you've already pushed against the many reasons why I stopped tracking so diligently. And it really was because there were like 40 categories and you could never win. And it was so impossible to know ahead of time what exactly you should be budgeting for something like entertainment when, all of a sudden you have multiple birthday parties and gifts to get, stuff like that. So I love the idea of having bigger buckets, as you say, with fixed and stable that you don't even necessarily have to track because you just already know what that's going to tend to be with a little bit of fluctuation. But then the flex dollars, groceries, and annual. I'm curious, is there a percentage that they should have in mind of what maybe their income is that would be wise to budget for those three flex categories? Like what should they be thinking of for groceries? The just flex ones, like where it's everything else that goes in that bucket, and then the annual kind of things.
I think a percentage is hard because it very much depends on where you live. I want to
Oh, yeah.
acknowledge that like my clients paying rent in DC are
Mm.
just going to spend a lot more of their income on rent than my client in a cheaper cost of living area. So let's talk about kind of overall targets though. One thing I will say is that going back to that category we don't track, the fixed and stable,
Mhm.
and not even the stable, but just the fixed expenses, which I would
'Kay.
say is housing, debt payments, childcare, and debt payments would include student loans, credit card minimums, personal loans, things like that. If all of those add up to more than about 40 to 45% of your income, everything's going to feel tight. Guarantee it.
'Kay.
So that doesn't mean that you have to change those things. Again, in some areas, you may not have a whole lot of choice, but you're just going to have to live with the tightness and know that it's not your fault.
Well,
Like, hear me say that it's not your fault in some areas if it feels like there's never money left when you have 42% or more going to fixed expenses. That doesn't mean you can't change it, though. And it's worth trying to change it if those aren't like a location specific problem that everyone is facing. Outside of that, I think it's more helpful to think of it less as a percentage and more as kind of a dollar target. So, what I do with clients when I go through cash flow is I say, well, average for this category is X dollars. If you're spending more than that, you're spending above average, which tells me either you aren't paying attention to your spending, it's not intentional spending, or this is something you value and you're okay spending more than most people here. Because that can also be the answer as long as the cash flow is healthy.
'kay.
So, for reference, averages, groceries, I normally expect to see spending somewhere between $300 to $500 per person per month, depending quite a bit on where you live and
You
how
know
you eat.
what? That number's up from when we talked last year. It was last year you said 200.
I think you guys do a good job with your groceries,
We
though.
do, but that was like so wow. So but that's nice to know though because that is
It
one of
has
the
gone up.
biggest impacts that it has gone up. Okay.
And I would say when I first started with clients, that range was probably $200 to $400, depending on the
Got it.
area.
Mhm.
And it's just crept up. Do I have the occasional client who spends like $250 a month on groceries? Yes. And also, I don't need everyone to be that. It's
Yeah.
hard in some cases, it can be hard to get there
Mhm.
um,
So 3
overall.
to maybe 500 per person per month in the household.
I would love it if you're closer to like 300 to 400 per person.
Okay.
But in some very high cost of living areas, I do see up to 500.
Got it. Okay.
So that's groceries.
Mhm.
Flex dollars. can vary wildly
Sure.
depending on how you live your life and what you value. But I would normally say that I don't worry about it for one person if you're between 500 to 1200. More than that, and I want to make sure you're spending intentionally.
Okay.
Again, may not be a problem, but like I guarantee you that $800 a month at Amazon is not bringing you joy. So that's one person. For a
No.
family, I mean, no one should be shocked by that, right? Like,
We all know it at our core. We
we all
know,
know
Elizabeth.
it. Yeah. For a family, I generally expect to see flex dollars, like I said before, between 2 to 3,000 a month. Yes, you can be lower and you can easily be above that. But if you're in that range, I'm not that worried about kind of that disconnect between intentionality and where your money's going.
Okay. And then what about the annual expenses?
That varies a lot. Insurance costs are going to depend on where you live. My client in Florida is going to pay double what I'm paying for car insurance. And
Yeah.
that just is what it is.
Mm,
Travel is also going to vary a lot because it depends on how big of a priority that is for you, how many people you're traveling with, what types of trips you're taking, what type of accommodations you're staying in when you're there. I don't tend to have a set rule of thumb for travel where it's like, if it's more than this, I'm worried. I pay more attention to how travel fits into the overall cash flow.
okay.
Because if you come to me and you tell me that you're spending 15 grand a year on travel, but you have a healthy amount left over every month to save and you have a fully funded emergency fund and you're saving enough to retirement, I don't care. Your money is making you happy and that is its primary purpose. Happiness and stability are
Yeah.
the points, right?
Mm-hmm.
If you're spending 15 grand a year on travel and you're drowning in consumer debt and you don't have an emergency fund, I'm going to have to be the bad guy and tell you that that's not okay. We
Sure.
have to cut back temporarily at a minimum until you're in a more secure place.
Okay. I know that's really hard to nail down like a specific percentage, but it's nice to have at least some targets in mind, even within that range, so that we can just, again, answer that question. Are we okay? Am I okay with money? And I think, everything you've come back to is the point of money is that stability and that happiness. And the cash flow is going to be the answer to that. And seeing, where things are going and knowing how much is even in there, which is, I think a lot of people avoid even looking, which is understandable too. But no, the knowledge is power here and seeing where your cash flow is. I have just a random question for you. Where would like piano lessons for Timmy go? Is that a flex bucket or is that more of an annual thing?
It depends on how you're paying it and how stable it is. So, if Timmy has just started piano and we're not sure that this is going to stick,
Yeah.
I'd call it flex dollars.
Okay.
If Timmy's piano teacher knows that Timmy is going to probably bail after week 2 and they want stable income, so they charge you for a year's worth of lesson up front, then it's annual needs.
Got it.
But if Timmy's been in piano lessons for 2 years consistently and we don't see that changing anytime soon, I would stick it in the stable bucket. I'm not worried about it.
Oh, okay. Interesting.
As long as you can afford it. But it's not something we have to actively track if it's an automatic payment every month.
Got it. Okay. So this is where the flexibility is actually key. I think people like me who want that certainty, but they get stuck in tracking and managing because that certainty is just so out there and not relevant to their lives. Like this gives us back the power to be like, what is stable? What can you
Yeah.
make sure is fixed? Then you put it in that bucket. There you go. You don't have to track it anymore because it's covered. And that goes back again to the cash flow. We didn't intend to start this with a budget breakdown. But again, that was the thing that I love so much personally in our sessions together is that way of knowing where your cash flow is, where it's going, and also how to manage it in a way that feels more doable. So I really appreciate that for people who are like all of us, I think, feeling the uncertainty of potential, if not inevitable, recession that's coming and how we can save for that. So thank you for breaking down both for us. And I do want to go back to one other thing too. You said 15% for savings. Um,
For
So
retirement
that's what I was just going to
specifically.
ask you. Okay, so 15% purely for retirement. For rainy day and the emergency fund, that's a separate thing. That's like you got to just do more on top of that until you get to a certain amount that's going to cover your expenses for at least 3 to 6 months. And like, oops, the car's transmission, hopefully not that. That's a really expensive one. The tires need to be replaced.
Right.
That's the rainy day fund. Okay.
So keep in mind that that 15% is pre-tax. If it's going into a 401k, for example, it won't feel like 15% coming out of your paycheck. It'll probably feel more like 10 to 12%.
Oh, okay.
And that 15% can include your employer match. So most employers, I mean, if you're self-employed, you're out of luck. But most employers give a 3% match. I see most commonly. If you have a really generous employer who gives like 10%, then all you have to do is 5, and that's no problem at all.
Yeah. Oh, awesome.
I don't see that all that often, but 3% is pretty standard, which means you only have to do 12, which means it's probably going to feel more like 10. And also, if you can't afford to do that, you can't afford your life. You can't afford the way you're living your life. And sometimes I have clients who come in and they can't get to 15% right away, especially when they have like 2 kids in daycare in DC. And if we have to like do slightly under 15% for the 2 years of overlap, fine. As long as we're all on the same page that as soon as that big expense leaves, we're going to jack up retirement contributions. We have to make sure that you get back to 15% because it's very easy to say, well, I know retirement's important, but I really do want to fix that deck. And we've been meaning to take that big vacation. And then suddenly it's been a decade. You never increased retirement. And now I have to tell you that you're behind and you're either going to have to work till 70 or give up a bunch of things you enjoy to save more aggressively now.
Okay.
So you don't want to have that conversation. Make the 15% a no-brainer. And if anyone listening is like just out of college in their 20s, or if you have loved ones who are just out of college in their 20s, set it to 15% from day one, because if you never see the money, you can never rationalize spending it instead of saving it.
And I love that point to make it automatic so that way it doesn't even land in your account.
Right. You don't want to see it in your checking account. And like the other thing though is that if you can't get to 15% now, but you get annual cost of living increases in your salary, you can often set it to increase your contributions by 1% a year.
Okay.
And so then it's again happening automatically. You don't really feel it. If it happens at the same time as your raise, it's not a big deal. So that would be my recommendation. If 15% isn't achievable now, you've cut where you can, you've made adjustments, but you want to get to 15% in the near-ish future.
Okay, fabulous. All right, I know that I am full of all kinds of curiosities. You've just answered so many though, and I think the most important right now in terms of the 5 steps to answer if you're okay, what a recession is, if or not it's coming, what to do now to prepare for that, and also what it looks like in terms of budgeting to help you do that and saving. So, Elizabeth, thank you for being both so helpful and exhaustive in this. I do want to tell them more about Fearless Finance, but I actually want you to tell them. What is Fearless Finance and what can they expect if they use your services?
Yes. Fearless Finance is a financial planning firm, but we're unique in how we do that financial planning. I think a lot of people think of financial planning as something that isn't accessible to them. It can feel a
Yes.
little daunting. It can feel like you're going to be judged or condescended to.
Mm-hmm.
That's not what we do.
Or taken advantage of.
Or taking advantage of, big one. And so we operate differently. We operate under an hourly model. So if you come in to work with a Fearless planner, you pay by the hour for the time you use with that planner. And that means that it's accessible to someone just starting out, someone who has debt that they want to take care of, and people who have plenty of money to invest. We're not ever taking a percent of those investments. We're not selling you products that you may or may not need. We have planners all around the country. We work with our clients virtually, so you don't have to be in our area. And also important, we are regulated by the SEC. We have a fiduciary duty to our clients, which means that we are obligated to put your best interest ahead of our own. Whenever you're looking for a financial planner, it's really important to understand how they're compensated, how they get paid, where that money comes from, and how they're regulated, what that process looks like. if you are working with a planner and you're feeling like it may not be a good fit, it may just not be a good fit for vibes reasons. And also, you should always check out a new planner on the FINRA broker check website, the SEC's IAPD website, that's Investment Advisor Public Disclosure. Because if someone else has filed a complaint, that can tell you that it's not the place you want to go.
Such good advice there. I mean, I long avoided finding a financial planner. One, because I'm like, we're not wealthy. So who's going to want us? And two, we're going to get taken advantage of by whatever percentage or products they sell. And it's been so helpful and also confidence boosting to work with you. And we've loved it so much. And it's made us feel more secure in answering those questions. Are we
Glad.
okay?
That's
So,
what we're here for. And anyone who, like, any questions, we can tackle them.
mhm.
We have someone who probably specializes in that area, and everyone else at the firm is lovely. We're a really good team. And this is all like, this is what we care about. We care about
Mhm.
helping people with their money and gaining that confidence and getting on the right track.
We initially started with the "Am I okay?" kind of session, right? And then we worked on how we could do better with retirement and shift things around and combine, which was so helpful. And coming up next, we're going to work on estate planning. So just as an example of what you can do, and every time I say estate planning, I feel like I'm on Downton Abbey. It's like, what's going to happen if something happens to you?
But you need it.
That's
Everyone
it.
needs it.
Everyone needs it.
Other things we help clients with include, like, I've helped clients with planning for a divorce and kind of what the finances
Mm,
of that look like. We help clients with student loan payoff strategies because student loans especially can be very convoluted and complex.
mm,
I've helped clients with how to buy their first house and how to start a family in a financially responsible way and getting out of significant consumer debt and retiring early and retiring at a normal place and leaving a legacy. And there's all of these topics that we're equipped to help with, and people can kind of bring whatever questions they have. And our model incentivizes us helping in a holistic way.
hmm
I'm not an investment manager who's only going to talk to you about your investment allocations. I care about the rest of it too.
I'm such a big fan. I love you. I love your
Thank
work
you.
so, so much. I'm going to direct them to fearlessfinance.com. And if they use the code PROGRESS, they'll get $50 off their first session. And just so we're clear, it's not an affiliate code in terms of me getting a payout each time they do it. It just helps them know they learned about Fearless Finance from us. And again, this particular episode is not sponsored. We always let you know if it is. I have received some free sessions from you. We've also paid for sessions. Again, such a huge fan of Fearless Finance and all you're doing with it, Elizabeth. Thank you so much for being on the podcast.
So happy to be here. Anytime you have random money questions, I'm here, happy to help.
Well, there's going to be plenty. There's going to be more. I hope this episode gave you the hug and kick in the pants you need to grow. I'll now share the progress pointers. These are the notes I took so you don't have to. And those on my newsletter get them in a graphic form each week. You can sign up at aboutprogress.com/newsletter. Number 1, ask, am I okay financially? Use 5 markers: stable cash flow, rainy day fund, full emergency fund, no high interest debt, and 15% save for retirement. Number 2, focus on what you can control. Don't spiral over headlines, study your own savings, spendings, and mindset. Number 3, simplify your budget. Group expenses into 4 buckets: fixed and stable, groceries, annual, and flex dollars you can track proactively. Number 4, prepare for uncertainty. Build extra savings, delay big purchases, and gently reduce spending. Progress, not panic. And number 5, automate your future. Set retirement savings on autopilot and increase your contributions as your income grows year after year. There was so much more that I want to cover with Elizabeth, so I am sure we're going to have her back on. And I would love to hear from you what you would like to know. She clearly knows, I don't know, everything. Anytime we've met with her, I'm like, question after question after question. And then by the end, we get to our session, I'm like, wait, I have way more. So I have loved my experience with Fearless Finance so much. As I said, they've given me sessions for free. We've also paid for sessions as well out of our own pocket, and we will continue to do so because it has answered so many questions for us. The first one being, are we doing okay? Again, you can get $50 off your first session using the code PROGRESS at fearlessfinance.com. I can't recommend it enough. This podcast is listener supported. Members of the Supporters Club make my work free and available to all. They also get access to 3 levels of exclusive benefits, from more time to more content with me. You can become a supporter by going to aboutprogress.com/support. One of my favorite benefits is my private premium ad-free podcast, More Personal, where I lean into the personal side of personal development. I recently just shared a full travel log of my time on my Pride and Prejudice pilgrimage. There might have been some shed tears over a cup of chocolate-covered strawberries. You can always support the show for free. Most importantly right now, do that by leaving a rating and review on Apple Podcasts. In doing so, you'll automatically get submitted to our yearly giveaway that I host around our anniversary of the show, usually in November. And since it's a rolling giveaway and there aren't that many reviews left so far this year, you are really likely to win something. So do us a solid, support the show, and get submitted to that giveaway by leaving a rating and review on Apple Podcasts. Thank you so much for listening. Now go and do something with what you learned today. And I love that point to make it automatic, so that way it doesn't even land in your account. At least your cash, your caching. Well, is that the word? What's the word for the account? Your cash account? Checking.
Oh.
Checking.
Right.